Friends, we will make the beginning of this session with transactions not to be regarded as a transfer. See, so far in our discussion, we understood one point after studying section 45, that in order to get taxed under the head capital gains, section 45 says there must be a capital asset and it must have undergone a transfer. So we studied what is capital asset and what constitutes the transfer. And we also studied what are the exceptions, like which assets, although capital assets, are not capital assets for the purpose of taxation under the head capital gains. Now we move to study transactions, although in general understanding are transfer, law is not regarding them as a transfer. These are all being covered by section 47. Of course, at the final stage, what is most important is not only studying that there are about 15 to 16 clauses of section 47, but all those clauses interlinking sections are what? Ultimately, at the end of the discussion, you should be in a position to well appreciate what is the objective behind saying a particular transaction as not to be regarded as a transfer. And earlier also I was saying the same thing, like any benefit the law is going to give, more it appears to me as of temporary in nature. Yes, why I am saying like that? My father acquired an asset. After his death, through will, I got that particular asset. Yes, cost to the previous owner is the cost to the present owner, and it will not attract any capital gains in the hands of my father, and the period of holding of my father will be the period of holding of mine. That is, it will be added to the period of holding of mine. Now the point here is, yes, let us suppose my father purchased with 60 lakhs. At the time when through will I got that particular property, the fair market value is 80 lakhs. Now this law says this 20 lakhs of the difference between the fair market value and the cost will not be taxed in the hands of my father. My father is happy, I am also happy. But subsequently, when I am making a sale of the same for 1 crore rupees, what is happening, friends? That 1 crore minus 60 lakhs, of course, benefit of indexation and those things are there. I am paying tax on what? Not on 20 lakhs of appreciation in my hands. On the entire 40 lakhs I am paying. So the benefit what we are looking at here, it appears to me only a temporary in nature. Right. So let us get into the subject proper, like which transactions section 47 would like to treat as not to be regarded as a transfer. First thing is distribution of capital asset, either on partial partition or on complete partition of a HUF. HUF got partitioned and the assets are getting transferred from HUF to the individual members of such HUF. Then it shall not be regarded as a transfer in the hands of the HUF and no capital gains tax. Similarly, where the transfer of capital asset is either by way of a gift or a will or through irrevocable trusts. Then transfer of a capital asset in a scheme of amalgamation of two companies. X company is getting amalgamated with Y company, and on account of this, what is happening? X is transferring its assets to the, what is it, Y company, but still it shall not be regarded as a transfer. The very good intention here is law want to encourage corporate restructurings. So that made the law to say, yes, in this situation it shall not be regarded as a transfer. Similarly, in case if a holding company, 100% holding company is transferring the assets to its subsidiary company, or a subsidiary company is transferring the capital assets to the, what is it, the holding company, then it shall not be regarded as a transfer. Of course, subjected to satisfaction of some conditions. But in all cases where we have in section 47, one thing you please do remember, whether it is amalgamation or holding company transferring to subsidiary company and all, receiving company need to be necessarily be an Indian company. 100% holding company is transferring to the subsidiary company. Who is the receiving company? That is subsidiary company. That must be necessarily be a Indian company is a point. So in all these 5 cases, it shall not be regarded as a transfer. Now the next issue is cost of acquisition. How do you look at the cost of acquisition? What is the principle? Whether it is a distribution of capital asset on partial or complete partition of the HUF, or transfer by way of a gift or through inheritance or your will, or by devolution, or by transfer to the by modes of irrevocable trust, what we are saying is cost to the previous owner is the cost to the present owner is the point. Of course, the point here is, sometime when we studied section 55, we discussed the point that in respect of the capital assets which are acquired prior to 1481, there is an option that either the cost or the fair market value as on 1481 will be given at the option of the SSE. Whichever is higher only he takes such option will be the cost. So also in this particular case also, when previous owner acquired the property prior to 1481, then the fair market value as on 1481 can be well adopted as a cost of acquisition as a point. See, cost of improvement, whatever the cost of improvement which is incurred after 1481 either by the previous owner or by the present owner will also be added to the cost. So period of holding, as far as the period of holding is concerned, period of holding of the previous owner will be added to the period of holding of the present owner is a point. See, in this context, one important thing is benefit of indexation. Benefit of indexation will be given from which year? There is a controversial view on this. One view is that benefit of indexation must be given only from the year in which the present owner is holding that particular asset as a point. Another view is that you can very well give the benefit of indexation right from the date or the year in which the previous owner is holding that particular asset as a point. See, Institute of Chartered Accountants of India's view is what on this? Of course, in our study materials and revisional test papers, it is clearly stated that whatever the views that are presented in the suggested answers and the study material and the revisional test paper necessarily will not form the view of the ICAI, and the board is not exhaustively reviewing this particular material and all. But definitely being the students of the ICI, we would like to go by what is being stated in the revisional test paper. See, standard textbooks, the other view is presented while solving the problems. That is, the benefit of indexation will be given only from the year in which the present owner is holding that particular asset. Let us suppose my father acquired an asset in 1986 and by inheritance I got that particular property say in 2008. Of course, period of holding of my father will be added to the period of holding of mine, but the benefit of indexation will be given only from the year in which I am having that particular asset in my hands. But the other view is being taken while the problems are solved in the institute examination problems or the study material problems, and for that the institute has got a point, that is, there are few tribunal decisions which says that the benefit of indexation can be well given from the year in which the previous owner is holding that particular asset. Of course, this matter is still pending in the High Court, different High Courts. So till such time the High Court or Supreme Court judgment gets pronounced or an amendment is being brought in the law, we will go to such kind of a view which is most beneficial to the SSC. And what view is most beneficial to the SSC is, that is, if the benefit of indexation is going to be given from the year in which the previous owner is holding that particular asset, that gives more benefit to the, what is it, the SSC is a point. Now friends, section 47A, here we will slightly deviate from section 47 and look at section 47A. Just now we discussed the point. In case a 100% holding company is going to transfer any capital asset to the subsidiary company, or a subsidiary company is transferring any capital asset to the holding company, 100% holding company, it shall not be regarded as a transfer. Yes, but subjected to the satisfaction of two conditions. What are those two conditions? That 100% holding company, either on its own or along with its other group companies which is holding 100%, should continue to hold this 100% of the share capital of the subsidiary company for how many years? For 8 years. And within 8 years, the transferee company, that is the receiving company, which received that particular asset, should not convert that capital asset into the stock in trade is a point. We are not saying that it should not make sale of that particular capital asset. We are only saying that such a capital asset cannot be converted into the stock in trade is a point. If any one of these two conditions or both the conditions are not met with, what will happen, friends? Earlier allowed exemption will get revoked, and consequently earlier completed assessment gets reopened and rectification will be carried out as a point. So to carry out that particular rectification, within how many years such a rectification can be done under section 154? Within 4 years from the end of the previous year in which those conditions got violated is a point. So these are the noteworthy points as far as the transfer and 47A at this juncture. Of course, your 47A is applicable in two more situations also. What are those other two situations? That is membership of a stock exchange you are transferring to the company, and in lieu of that demutualization, that is you are getting shares in that particular company and trading and clearing the rights. There also we expect you to hold those shares for 3 years. failing of which earlier allowed exemption will get what is it taxed. Now, of course, in the case which we discussed now, holding company transferring to the subsidiary company, or in the case just now I discussed like membership of a stock exchange getting converted into shares of the company and the trading and clearing rights, whenever the violation is there, who is supposed to pay the capital gains tax? It is a transferor, because transferor as an SSE is still an entity existing. When 100% holding company transfers the capital asset to the subsidiary company, or subsidiary company transferring the capital asset to the 100% holding company, here it is not a case that the transferor company is getting into liquidation and making the transfer. Both are going concerns only. That is the reason why whenever there is a violation, what should happen, friends? Who should pay the tax? It is the transferor. Whereas the third situation dealt by section 47A is what? When a sole proprietary firm or a partnership firm is getting converted into company, then also we say it shall not be regarded as a transfer subjected to certain conditions, which we definitely go through. There also, if there is a violation in those conditions, then earlier allowed exemption will get revoked, and now the SSEs need to pay the tax. But by the time the violation is happening, what is happening? That sole proprietary firm is no longer in existence, and that partnership firm is no longer in existence. So who is going to pay the tax? For the violation of the conditions, it is the transferee company which is going to, or transferee which is going to pay the tax. That is the one difference between the first two and the last one. So all these points we have to make note and clearly get into the understanding. So at this level, just make note of few points. Section 47, transactions not to be regarded as transfer. Transactions not to be regarded as transfer. Number one, distribution of capital assets. Number one, distribution of capital assets on partial or total partition. On partial or total partition of HUF. Total partition of HUF. Then number two, any transfer of capital assets, any transfer of capital assets under a gift or will, comma, by succession, comma, inheritance or devolution, or devolution, or under irrevocable trusts, or under irrevocable trusts. Then transfer by 100% holding company to subsidiary company, or what are subsidiary company to 100% holding company, of any capital assets, of any capital assets. Friends, at this juncture, please remember, this is applicable only in situation when the transfer is made of a capital assets. It shall not be regarded as a transfer. But if you are transferring an capital asset as a stock in trade, you are making a transfer of a capital asset not as a capital asset but as a stock in trade, then section 47 will not have any application. It shall be regarded as a transfer, and accordingly it will be liable for the capital gains tax. So I think all of you are clear with this point. When we give the benefit that whenever capital assets are getting transferred by 100% holding company to subsidiary company, or subsidiary company to the 100% holding company, it shall not be regarded as a transfer. That benefit will be only when asset is getting transferred in a capital asset form, not as a stock in trade as a point. And of course, conditions here are what? Conditions to be satisfied. Conditions to be satisfied. Number one, receiving company, that is transferee company, is an Indian company. Then number two, 100% holding company or its nominees shall continue to hold 100% of the share capital, 100% of the share capital of the subsidiary company for a period of 8 years, for a period of 8 years from the date of, what is most important is, whenever you read these things, when you read that period, it should commence from which date. You are supposed to be very clear on that. So this 8 years period, you should count from which date, friends? From the date of transfer of capital assets. Then the next condition, friend, such a capital asset should not be converted into stock in trade by such transferee company, So in case if there is a failure, what will happen, friends? Of these two conditions, if there is a failure, then 47A gets into play. What section 47A says? Write down. Section 47A. Section 47A. In case 100% holding company cease to be 100% holding company, 100% holding company cease to be 100% holding company, or receiving company convert such capital asset into stock in trade, then earlier allowed exemption will get revoked, revoked, and earlier completed assessment will get rectified, under section 154, will get rectified under section 154. Now the noteworthy point here is, within what time such rectification should be carried out? Write down. Rectification under section 154 shall be carried out within 4 years, from the end of the previous year, in which stated conditions got violated. Here one more noteworthy point. See what we said, in all the modes prescribed under section 49(1), cost to the previous owner is the cost to the present owner, irrespective of the fact at what value the asset is getting transferred by holding company to the subsidiary company or subsidiary company to the holding company. But once the conditions gets violated and section 47A is invoked, law is kind enough to say that what will be the cost of acquisition through section 49(3). Your 49(3) says what? Because of 47A coming into play, if the transferor company is liable to pay the capital gains tax, then the cost of acquisition of such asset in the hands of the transferee will be what? The price at which the transfer is made. Only when there is a benefit of not being regarded as a transfer, then the transferee should take that capital asset in his hands at the cost to the previous owner. Once because of this condition being violated and the transferor company is liable for a rectification and is paying the capital gains tax, then the cost of acquisition of such asset in the hands of the transferee will not be the cost to the previous owner, but it will be the value at which the asset got transferred by the holding company to the subsidiary company or subsidiary company to the holding company. This important point also you just write. Section 49(3). Section 49(3). Cost of acquisition in a situation where section 47A is attracted, In such situation, cost of the asset transferred in the hands of the transferee company will be, the price at which the asset was transferred, by the transferor company. Transferred by the transferor company. Right. Now the other points, again we come back to section 47. Write down cost of acquisition in all the modes of a transfer covered by section 47 clause 1 to clause 5, clause 1 to clause 5 will be the cost to the previous owner, will be the cost to the previous owner. Then another important point is period of holding of the previous owner. Next point, period of holding of the previous owner shall be added to the period of holding of the present owner. Of course, period of holding in the law is being discussed under which section? 2 clause 42A is a point. And then third and foremost important thing and controversial thing is what? Benefit of indexation will be given from which year? Write down benefit of indexation. Make it side heading, benefit of indexation. There are two views on this particular issue. There are two views on this particular issue. First view, cost of indexation should be available. Cost of indexation should be available either from 1981-82, either from 1981-82 or from the year in which the present owner or from the year in which, not the present owner, from the year in which the previous owner, not the present owner, the previous owner first held the asset, whichever is latter, whichever is a latter. Second view, this is the first view. Second view, benefit of indexation will be available. Benefit of indexation shall be available. Benefit of indexation shall be available from the financial year, in which or from which, financial year from which the present owner is holding that particular asset, Of course, friends, which view we are going ahead? As already I told, there are some standard textbooks where the second view is given the relevance or the importance, and the problems are solved in some standard textbooks taking the second view. But Institute of Chartered Accountants of India, through its revisional test papers and all, encouraged the first view, and the benefit of indexation is given from the year from which the previous owner is holding that particular assets. So as a student, you should remember that we should go by the thing which is presented in the ICAI material till such time we get some High Court judgment or Supreme Court judgment accepting the second view. But first view is going to be more beneficial. Even for that matter, that is special bench of Mumbai Tribunal also accepted with that particular first view in case of Mrs. Pushpa Sofat case, and a few other tribunals also accepted for the first view. So we are going to solve the problems based on the first view. So one thing that should be clear in your mind, in case if such a controversial issue appears in your paper, you should give the benefit of indexation from the year in which the previous owner is holding that particular asset. Of course, if the asset is acquired by the previous owner prior to 1981-82, then the benefit of indexation must be given from the base year of 1981 and 82. And in case if the previous owner acquired that particular asset after 81-82, then whichever is later we said, so the year from which the previous owner is holding that particular asset, you should give the benefit of indexation to the present owner. Not only that, cost to the previous owner is the cost to the present owner, period of holding of the previous owner will be added to the period of holding of the present owner. Even the benefit of indexation, we are encouraging it to be given from the year in which the previous owner is first holding that particular asset as a point. Then, of course, many times earlier also we discussed the point that if any asset is acquired prior to 1481 by the previous owner and subsequently it reached the hands of the present owner after 81-82, one point is clear: whatever the improvement cost that is being incurred by the previous owner, that should be ignored. Only the cost of improvement incurred by either the previous owner or the present owner subsequent to 1481 should only be considered as a cost of improvement. Earlier also you wrote this particular point, so I am not troubling you again by asking you to write as a point. Another important point, noteworthy point that you should make note is whatever we discussed, like that is it shall not be regarded as a transfer only when capital asset which is transferred by the holding company to its subsidiary company or subsidiary company to the holding company is being transferred as a capital asset and not as a stock in trade as a point. So just make note. That is, exemption under section 47 will be available when capital assets gets transferred as a capital asset. And in case if it is transferred as a stock in trade, then exemption provided under section 47 shall not be available. available. That is, this point is when holding company is transferring to its subsidiary company or subsidiary company is transferring to the holding company is a point. Now, in this context, let me also educate you on the section 43C. What is your section 43C? Special provisions for computation of cost of acquisition in certain cases. Friends, please do remember, section 43C discusses about the cost of acquisition. Like when in a scheme of amalgamation, capital assets are getting transferred by the vendor company to the purchasing company, it shall not be regarded as a transfer is what we discussed. Yes, this principle is applicable only when that asset is transferred as a capital asset. In case if transferor company is transferring that particular capital asset not as a capital asset but as a stock in trade, then it is not a case of cost to the previous owner is the cost to the present owner. What is it? It is the cost to the amalgamating company plus any cost of improvement to the said asset and any expenditure incurred wholly and exclusively in connection with such a transfer put together will become the cost of acquisition in the hands of the, what is it, the transferee company is a point. See, the same principle will be applicable. 43C is also having an application in a situation when a particular capital asset is getting transferred by way of a gift or a will or irrevocable trust or on partition of the HUF, if the capital asset is not getting transferred as a capital asset but it is getting transferred as a stock in trade, there also what we say, that is, it is not a case like cost to the previous owner is the cost to the present owner, because there also 43C comes into play and will say that cost to the present owner will be the cost to the previous owner plus any improvement cost and any expenditure incurred in respect of that particular transfer put together will become the cost of acquisition as a point. Of course, please do remember, wherever you are invoking 43C, wherever you are invoking 43C comes into play when? First, that mind wise you should have the clarity on it. Invoking 43C comes into play in case of amalgamations, in case of a transfer by way of a gift, will, inheritance, or that is gift, will, irrevocable trust and all. When a capital asset is getting transferred as a stock in trade, 43C comes into play. In that situation, let us suppose previous owner is acquiring the asset prior to 1481, the general principle that cost or fair market value as on 1481, in such situation it shall not be available as a point. Only you take the cost, not the fair market value as on 1481 will be allowed as a point. And cost of improvement, of course, only when it is incurred after 1481 it shall be considered is anyhow the point, but once 43C comes into play, please remember, even the cost of improvement incurred prior to 1481 shall also be included as a point. So these two are very important issues when 43C comes into play, and once 43C comes into play, what is cost of acquisition and what is the cost of improvement. See, here try to understand, we have discussed 5 things in section 47. What are those 5 things? One is HUF getting partitioned. Second is either through will or gift or inheritance or succession or devolution, asset getting into the hands of the present owner. Third is amalgamation of companies. Fourth is 100% holding company transferring its capital asset to the subsidiary company. Fifth is subsidiary company transferring the capital asset to the, what is it, 100% holding company. And in case if the conditions are not met with, that is the asset must not be converted into stock in trade, and the holding company, 100% holding company must continue to be the 100% holding, then 47A comes into play is a point. And 47 altogether will not come into play once it is a case of capital asset is getting transferred by holding company to subsidiary company, or subsidiary company to the holding company as a capital asset, but as a stock in trade if it is getting transferred, then 47 benefit will not be available. Once 47 benefit is not available, then it is not a question of cost to the previous owner is the cost to the present owner, it is the cost at which the asset is getting transferred by the transferor company to the subsidiary company is a point. There you don't have 43C coming into play. 43C comes into play only in the first three situations, that is on the situations of your capital asset getting transferred by transferor company to the transferee company in a scheme of amalgamation, or partition of the HUF, or transfer by irrevocable trust, or by gift or will. In these situations 43C comes into play. That is their capital asset is not getting transferred as a capital asset but as a stock in trade. Once 43C comes into play, what is the consequential effects? Consequential effects is what will be the cost in the hands of the present owner is the cost in the hands of the previous owner plus any improvement cost, any expenditure incurred in connection with that particular transfer shall be the cost of such a stock in trade is a point. And that concept called as a cost or fair market value as on 1481 will not be available, and cost of improvement incurred prior to 1481 will also be included in the cost is the point to be well remembered is a point. See why the law need to bring these kind of the provisions, because otherwise our SSEs are very intelligent. See, in bringing 43C into play, there is a loophole in the law which the law want to plug in. You can just feel it by an example. Let us suppose there is a company, there is a manufacturing company, and there is a land for it, and what it is doing is it is transferring such land to the B Limited. Who is B Limited? It is it's a 100% Indian subsidiary. But what is happening? And that subsidiary company is what? Mainly engaged in the real estate operation. So now the transfer they are making to that particular B Limited. Now while the transfer is made, it is made not as a capital asset but as a stock in trade. Then what will happen? Your 47 will not come into play. It shall be regarded as a if you are 47, don't say that capital asset must be only transferred as a capital asset but not as a stock in trade. What will happen? Your 47 will help the manufacturing company A Limited, which happens to be transfer company, to the benefit that it shall not be regarded as a transfer. Let us suppose A Limited purchased that particular land for 1 lakh, and at the time when the asset is getting transferred by A Limited to the B Limited, the fair market value is 100 lakhs. So holding company is happily able to do what? Avoid on 99 lakhs. What is it? 99 lakhs, the tax burden, capital gains tax burden. Now that particular asset in the hands of the subsidiary company is not a capital asset, it is a stock in trade. Now such a stock in trade, let us suppose that particular subsidiary company makes a sale for 101 lakhs. What will happen? The difference between 101 lakh and 100 lakhs only 1 lakh they are going to offer as a, what is it, profits and gains from business and profession. Thereby 99 lakhs of the capital gains remains untaxed both in the hands of the holding company as well as in the hands of the subsidiary company. What we want to convey is, again, listen carefully. Holding company purchased the land with 1 lakh, right? He transferred that particular capital asset as a stock in trade to the subsidiary company, 100% subsidiary company, for 100 lakhs. Now, in the absence of this 43C, what will happen? It shall not be regarded as a transfer. Once capital asset is getting transferred by the, what is it, holding company to its 100% subsidiary company, it shall not be regarded as a transfer. Now the capital asset it is not getting transferred as a capital asset, it is getting sold to the other company, and other company is engaged in the real estate. So for it, it is a stock in trade. So Happywell, because using 47, what will happen? That holding company will not pay the tax on that 99 lakhs. Having purchased it at 100 lakhs, now the subsidiary company, if it makes a sale at 101 lakhs, only 1 lakh it is going to show as a PGBP, profits from gains and profits and gains from business and profession. So every fellow who want to avoid the capital gains tax, what he will do? If he has got a land, he will float a company, he will float a subsidiary company, and transfer the asset from the holding company to the subsidiary company as a stock in trade, and avoid the capital gains tax, and that other fellow is going to make sale, that is a subsidiary, 100% subsidiary company ka matlab kya hua? Almost this company only extension file. So that company makes a sale, and only the difference between the sale proceeds and the purchase cost of it is going to be offered as a PGBP, profits and gains from business and profession. Then the law is not at a, that is revenue is at a loss? Yes. So to plug in this particular loophole, they brought the concept of section 43C. So ultimately the discussion should make you to get into a clear understanding that is only this 47 will be having any application only when such a capital asset is getting transferred as a capital asset and not as a stock in trade. Once capital asset is getting transferred as a stock in trade, then 47 will not come into play, and capital gains need to be necessarily be paid is a point on such a transactions.